Meet Margaret. She's 44 years old, October 1929. She has never bought a single share of stock in her life. She calls the stock market gambling for rich men. For 20 years, she did everything the world told her was responsible. She worked, she saved, she walked into her local bank every month and deposited every spare dollar she had. By the morning of November 12, 1930, her bank is gone. Not struggling, not in difficulty, gone. The doors are locked. There is a handwritten notice on the glass. Her life savings vanished. Every penny she ever saved. She never speculated, she never borrowed, she never played the game. Margaret was not unusual. She was one of millions. Between 1929 and 1933, 9,000 banks in America simply vanished. $7 billion in deposits, real money belonging to real people, disappeared overnight. Most people still believe the Great Depression was caused by the stock market crash. They're wrong. Markets crash all the time. Markets recover. The 1987 crash was worse in percentage terms than 1929. The dot-com crash, the 2008 crash, the 2020 crash. None of them created a Great Depression. What turned a market crash into a decade-long catastrophe that caused 25% unemployment and reshuffled the political map of the entire world were the banks, and specifically a mathematical trick that sits inside every bank on Earth. Right now, today. Let's get into it. To understand what happened to Margaret, you first have to feel the world she lived in. The 1920s in America were unlike anything the world had ever seen. New technologies exploding everywhere: cars, telephones, electricity, radio, movies, and a new class of ordinary people discovering something extraordinary, that they could get rich by buying pieces of the companies producing all of it. In the 1920s, if you wanted to know the health of American capitalism, you needed to look at the Dow Jones Industrial Average. It wasn't a single company. It was an index that tracked the 30 most powerful, bulletproof corporations in the country. In August 1921, the Dow stood at 63 points. By September 1929, just 8 years later, it had reached 381, an increase of over 500%. The 30 most powerful companies in America had become a machine for creating wealth. But there was a dangerous detail buried inside the boom. Most people were not buying stocks with their own money. They were buying on margin, borrowing from brokers. The margin requirement in 1929 was 10%, which means you hand over $100. The broker lends you $900. You buy $1,000 of stock. If the stock rises 10%, you double your money. If the stock falls 10%, you lose everything you put in. And if it falls further, you owe more than you started with. By the summer of 1929, the entire financial system was a tower of borrowed money stacked on borrowed money. And on September 3rd, 1929, the tower stopped growing. The crash didn't announce itself. In September 1929, prices drifted downward, slightly. Then in early October, a little faster. Still nothing that looked like catastrophe. Then came October 24th, Black Thursday. The moment investors looked at the drift and panicked simultaneously. A record 12.9 million shares traded hands in a single day, most of them at falling prices. The ticker tape machines were so overwhelmed they fell hours behind. No one on the floor even knew the real prices anymore. 5 days later, Black Tuesday, October 29th, 16.4 million shares were dumped. By July 1932, the Dow had fallen 89% from its peak. If you had invested at the peak, you would not break even until November 1954. 25 years. A quarter century simply to get your own money back. But an 89% stock market crash, as horrific as that is, should not have destroyed the entire economy for a decade. Markets crash, markets recover. What turned 1929 into the Great Depression didn't happen on the trading floor. It happened at the front door of Margaret's local bank. Here is the single most important thing you need to understand about modern banking. When you deposit $1,000 into your checking account, you believe that money is sitting safely in a vault, waiting for you. It isn't.
The bank is legally allowed to keep only a small fraction, say 10% or $100 in reserve. The remaining $900 is lent out to someone else, a home buyer, a business, or in 1929, a stock speculator. That borrower deposits the $900 loan into another bank, which keeps 10% and lends out $810, and so on. Your original $1,000 deposit can create up to $10,000 in the total money supply. This is not a bug. This is fractional reserve banking. In normal times, it works beautifully. The bank earns interest on the loan, the borrower gets capital, the economy grows. But the entire system rests on one invisible assumption. Not everyone will ask for their money back at the same time, because if they do, the money isn't there. In 1929, banks were lending $9 for every $1 deposited. The entire financial system was operating at maximum leverage with minimum reserves. When stocks began falling and margin calls went out, borrowers defaulted. The banks that had lent depositors' money to stock speculators suddenly had loans that were worthless. And then the rumor starts. Did you hear? The bank down the street is in trouble. You have $2,000 in savings, your entire emergency fund. You tell yourself it's probably nothing, but what if it isn't? You walk to the bank. There's already a queue. That queue is the spark, because once people see other people withdrawing, they join, and the queue grows and word spreads. This is a bank run. And here is the part that should make you furious. A bank run does not require the bank to be insolvent. A perfectly healthy bank, one that lent responsibly, can still be destroyed because no bank keeps 100% of deposits in cash. It doesn't matter if a bank is fundamentally healthy. If the public believes it is failing, they will demand their physical cash and mathematically force it into bankruptcy. Between 1929 and 1933, 9,000 banks failed, $7 billion in deposits, real people's life savings simply ceased to exist. In December 1930, the Bank of United States, the fourth largest bank in New York City, failed in a single day, taking $160 million in deposits with it. Its name alone caused widespread panic, as many depositors believed it was a government institution, which means Margaret, our woman from the hook, didn't lose her savings because her bank was necessarily reckless. She lost them because enough people in her town were afraid, and fear in a fractional reserve system is lethal. When the dust settled in the mid-1930s, governments looked at the wreckage, and they asked a simple question: how do we prevent this from ever happening again? The answer came in three pieces. Piece 1, deposit insurance. The government created the FDIC, the Federal Deposit Insurance Corporation, in 1933. The promise was simple. Even if your bank fails, the government guarantees your deposits. Today, in the U.S., deposits up to $250,000 are federally insured. In the UK, up to £85,000. The bank run's psychological trigger, the fear of losing everything, is largely neutralized. Because even if the bank fails, you don't lose your money. Piece 2, market circuit breakers. If the market drops too fast, trading is automatically halted. If the S&P 500 drops 7% in a single session, trading halts for 15 minutes automatically. If it drops 13%, another halt. If it drops 20%, the market closes for the day. It forces humans to pause before panic takes over. Piece 3, the lender of last resort. The most important lesson of 1929 was this: the Federal Reserve let the banks die. Their decision to let banks fail rather than inject liquidity was the primary cause of the Depression's severity. Modern central banks now operate with one non-negotiable commitment. They will print whatever money is required to prevent a systemic banking collapse. And in 2008, they kept that promise. The Great Depression wasn't just a failure of the stock market, it was a failure of the banks that gambled with the working class's money. And while the modern system has firewalls, it is still built on that exact same foundation. The question isn't whether another crash will happen. Crashes always happen. The question is whether the next one will find the cracks in the firewalls. What do you think? Drop your answer in the comments. If this opened your eyes, subscribe. I'll see you in the next one.